Hello and welcome to Money Matters TV. My name is Robin Bond, and I am pleased to be your host today. This is my first time officially hosting the show. And so I wanted to introduce myself a little bit. I'm an employment lawyer in Wayne, Pennsylvania. My firm focuses primarily on representing executives in the negotiation of their deals, whether those be new employment offers, equity, or severance matters, all of which involve money, right? So Money Matters TV seems like a perfectly good fit, and I'm honored to be here today. My co-host is Evelyn Klein-Whitfield, and Evelyn is a tax resolution expert specialist. And what a wonderful thing to have on today after the new tax bill was just passed in July. And when I heard that Evelyn was going to be our guest, I'm like, wow, what does a tax resolution expert do? And gosh, tell me how you can be helpful to our viewers in light of this new tax bill.
Well, thanks, Robin. I appreciate the introduction. Basically, I'm the ER doctor for taxes. You call me when you have an emergency and you can't figure out what to do. Tax resolution people give you peace of mind, protection. We help protect your assets. We try to resolve issues with the IRS. Well, not try. We do resolve issues with the IRS regarding offers in compromise, installment payments. We get the IRS off your back so you don't have to deal with them. Once you've engaged a resolution specialist, we take it from there. You never have to talk to the IRS again.
Wow, that's a great selling point. I'll tell you, anybody would love that. And there's all these IRS scams going on. So to me, it would be like, well, gosh, what do I do if I get one of these letters that says, oh, Robin, you owe the IRS $1 million? I think I'm going to call you right away.
Well, I hope so.
Yeah.
Well, I hope you don't get the letter. That would be the best part of it. But
yeah,
yes, there are lots of scams out there. I mean, it's sort of like everything else. They'll tell you anything you want to hear, but when it comes time to actually produce, it's a different story. There are all these exceptions and options. Basically, like everything else in the IRS, you have to qualify for everything that you do. You don't get a deduction unless. You don't qualify for tax relief unless.
Right.
So it's our job to sort those things out and to help you figure out exactly where you belong and what we can do to help you. And then we go about getting it done.
Yeah. And, we've all been reading about the huge cuts in personnel at the IRS.
36%
Yeah.
they've been cutting.
Yeah. And so now I understand they're replacing people with artificial intelligence.
Yes,
So
exactly.
that just must be terribly exasperating for people. So I'm all for putting that exasperation on your shoulders. I'm sure you're prepared to deal with that, right?
Absolutely. And it is exasperating. One of our recent webinars, they said that the IRS is a circus and the tent is burning and the clowns have taken over.
Oh my God, that's good. Well, it is kind of scary because, boy, if I can't talk to a person and a machine says, oh, okay, day 10 is here, time now to garnish bank account. All right, day 20 is here, time now to file lien on house. I'm like, oh my God. So I'm glad that people now know about you and can, get this help when they need it to prevent these bad things from happening.
Well, bad things sometimes happen to good people. So it's just a matter of following the program, doing what you need to do. And first thing you do is take a breath and don't panic. We'll handle it.
Right. Okay. Well, how about you handle this question? We have a viewer question here from Jeff Rogers in Philadelphia, and he's asking the question, what do I do if I get a notice from the IRS that I owe money? Could you help Jeff with that answer, Evelyn?
Well, as I said, the first thing to do is take a breath, don't panic, then call someone to help you, someone in the tax resolution business. We will sit down with you. We'll figure out exactly what the letter means, what they're trying to. Sometimes they're just asking for information. Sometimes they're asking for money. Sometimes they're saying you made a mistake when you calculated your return, or you forgot to add these 5 1099 income statements to your tax return, and now you owe tax on it, plus penalties, plus interest, and so forth and so on. Our job is to research it, get your transcripts, figure out exactly what you owe, why you owe. negotiate with the IRS to reduce penalties. Unfortunately, we can't do anything about the interest, but we can usually get a first-time penalty abatement. We can relieve the liens, and we can get you going in the right direction to get the amount paid or negotiated down.
Well, thank you so much, Evelyn. Thank you. And to the rest of the viewers, if you have any questions, here's how to send your questions in to Money Matters TV.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.com.
Thank you. And we are very pleased today to have as our guest Arron Bennett, the founder of Bennett Financials. And he has a very interesting firm that services small businesses, everything from CFO services to exit planning to tax preparation. And welcome very much, Arron. Thanks for taking time to join us today.
Thanks for having me.
Yes, and we'd like to just kind of dive right in because we have a lot of questions for you. But
Yeah.
What is the biggest financial mistake you see business owners making when they're trying to scale? I mean, everybody's trying to scale up. So how does it show up in their revenue strategy?
So it's really, really simple. And it's simply starting to track the metrics. There are so many businesses out there that just do not track their metrics correctly. And that's the first thing that's necessary. The second thing is start putting targets in place. It may not be that you actually hit that target, but you're able to then start looking at how far off the mark we are. So then we can start finding where the bottlenecks start. And that's really the next phase of this, is understanding those bottlenecks.
All right. And when you say metrics, though, give me an example of a couple metrics. What would examples be?
So I'm working with a company right now. They were bleeding about $70,000 a month, and all we had to do was work out that their customer acquisition cost had skyrocketed over time, but their revenue or their average order value had remained flat. So we were able to see between the two that our cost to acquire a customer went up 300%, but their average order value remained the same, and that's what was causing them to bleed cash. We were immediately able to rectify that by raising prices, and the very next month, we were able to make $59,000 in profit.
Oh, excellent. Evelyn, how about you? You have a question?
Yes, you talk about building margin before growth. How does the financial structure actually enable a smarter business development plan?
So if you're looking at margins before growth, and we work with service-based businesses, so if we're able to work out how to keep our margins the same as we scale revenue by looking at what our close rate is to make sure that we've priced our product correctly, or our revenue per employee is at about the 1 to 250,000 mark, what's going to happen is we're going to be able to scale, because in a service-based business, that's where a lot of your variable costs are. It's always tied to people, and you're going to lose a lot of that margin right there. But if you can ensure that your revenue per employee is 1 to 250,000 and your close rate is between 30 and 40,000, you're going to pad those margins, and then it's all going to flow through to the bottom line, because then you have your G&A and sales and marketing and costs.
Well, when you're talking about some of these things, like, I represent a lot of CFOs in the world, and they care a lot about these KPIs, or key performance initiatives. What do you think CFOs need to care about? What KPIs do you actually care about if you're the CFO?
So I'm a little bit weird in how I do things, because I like to grow companies. So I'm always looking at things from sales and marketing. So cost per lead, cost per book call, Then we're looking at our no-show rate, all the way down to our lifetime value of our customer. So one of the key ones that I like to watch is how much does it cost us to acquire that customer? How much does it cost us to service that client? And then what is the lifetime value of those customers? Because if you put all those three together, you're going to bake profitability into the company, and then you're going to be able to scale it very, very rapidly.
Those are great. Those are great answers. I wish I could have written them down. Maybe I'll follow up with you afterwards to get that in writing.
We'll have to do that.
It's always fun.
Talking about strategies, what separates a good bookkeeper or controller from a real CFO in a company?
So this is really, really important for a lot of small business owners out there. Bookkeeping is the foundation of the business. And so the most important part of that is our balance sheet. So a good bookkeeper is going to be reconciling the balance sheet reliably and consistently, at least every quarter, to make sure that the books are correct. Because if the balance sheet is wrong, everything else is wrong. And then all of the decisions around finance are going to be wrong. The next piece is making sure that we have the controller. Controller is going to take all of the data sets and put parameters around our spending, around our data collection, and making sure it's reliable and consistent. A CFO is all about strategy. CFOs are forward-facing, controllers and bookkeepers are all going to be retroactive data.
Wow, that's great. Well, you've worked with a lot of companies, Arron, from what I understand, in the $5 million to $20 million range. And as you said, these are often service companies. So what trends do you see in terms of how founders can sabotage their own profitability? Even when the revenue looks good, they end up sabotaging themselves.
There's three big ones. The first one is the business owner cannibalizing the company. Because they've gotten to that 5 million range and they've grown either slowly or quickly, their lifestyle starts to change. So then they start drawing too much money from the business. And that ultimately can hurt the business over time, because if you have a slump in sales, there may not be enough cash to get the ship and back on course, so to speak. The next one is that the business owner looks to hire too many people too quickly. So they're doing too much too fast. Like they want to hire a COO because they want to get out of the day-to-day. They need a CMO, they need a CRO, and they try and hire all three at once. And then they don't know what breaks. And then they start to see their profitability suffering, as well as sometimes their revenue start to drop. And then the third one is leveraging the company with too much debt too quickly to try and mitigate their taxes, and then using the 100% bonus depreciation rules or Section 179, but then they don't realize that they've got that debt that they've got to pay over 5 years, and that's going to impact their cash flow without necessarily impacting their profit and loss.
Too much debt. Debt is bad, except sometimes it's good. So
it's good if you can make money off of it.
Yeah, the spread, right? Okay.
You've mentioned that a lot of business owners consider finance as reporting, and you see it as a strategy. Could you elaborate on that?
So it's not really a report for us. It's working out where the bottlenecks are in the company. So if you split your profit and loss and your KPIs very clearly, what you're able to do, and what I do with a lot of companies that I grow, is we put together like a dashboard, and we have from lead flow all the way to profit, and we're able to put those targets in place for them. And then what we're actually able to do is when they don't meet targets, we can point to the exact problem that they need to focus on today to allow for profitability and or more revenue growth throughout the company. So that's the most important thing, is just being able to point to the owner and say, hey, focus on this right now, get this fixed, and then you'll have XYZ amount of profit growth.
You talk a lot about strategy, Arron, and I understand that's, really important, but how does strategic tax planning support this long-term, business development that you've talked, beyond just saving money today? Talk a little bit about strategic tax planning.
So, growing a company fast requires cash flow. And so, one of the goals that I have for the businesses that I work with is how do we get cash savings from the IRS to fuel future growth? So, there's structures out there that you can invest in. There's equity investments that have a taxable benefit that you can put money into that isn't just giving you putting $1 in and then getting 30 cents reduction. You can actually put $1 in and get a $2 reduction of your taxes. So then we're able to keep more money in the company, and then we're able to fuel the company's growth very, very aggressively. So there's a lot of different plays that you can have here where you use tax to fund your future growth. So you don't have to leverage so much debt or lines of credit and those types of things. You can just keep it within the business.
Yeah, I need to follow up on that because I don't really understand that. I know tax deferral strategies like small businesses can fund their own pension plans, like their own defined benefit plans.
Yes.
Is that the kind of what you were talking about when you said you save 30% instead of the $2? But what kind of a plan are you talking about where you put $1 in and you get $2 back? What kind of thing would that be?
There's a leveraged charitable structure out there, and not to be confused with the conservation easement, because I'm sure Evelyn has heard about that and really dislikes that strategy. Same. But there's a leveraged strategy out there that allows you to put $1 in, and then you're able to get a $5 deduction up to 50% of AGI by donating to a charity. And these charities are structured around funds and are SEC regulated and those types of things. And so you're actually able to get more than a 30% or 30 cents discount by investing in a structure like that. So then you're going to be able to make it so that you only get taxed on 50% of your AGI. And that's going to allow you to fuel future growth because now that 50% isn't taxed. And when you're above 5 million, say you've got 2 million in profit, well, now you're only going to get taxed on 1 million.
Oh, okay. I see. So,
Well, that's certainly helpful. You say that tax planning is a 12-month process, not a 12-week scramble. What does that look like in actual practice for a high-earning service business? Because service businesses are typically the ones you're likely to be dealing with.
Yes. So tax planning at the end of the year, there's strategies that are coming off the table. So all of the small fun things that you can do through the year that takes benefit to the owner, and I'm sure you've heard of hiring your kids, those types of things need to happen through the year. And you're able to then have these different milestones and different things that you can do. So if you're just waiting till the last 12 weeks or the last 3 months of the year, all of that 9 months worth of strategy that you could be doing is no longer available to you because you have to have substance and form. So you have to have the right paper trail. You have to have the money move a certain way. And if you try and squeeze it into 3 months, you're leaving money on the table every single time. And so you have to make sure that you do this right, because if not, the IRS is going to find out eventually. It's easy to track the money.
back to that. Well, maybe you could weigh in on that, Evelyn. I'm like, I don't know. Do you ever have that kind of an issue that you have to resolve?
Oh, yes, all the time, because people they do something at the end of the year thinking that they can sort of prorate it throughout the year or stretch it out throughout the year, but the time for reporting that money has already passed. So now they have to dump it into last quarter, and that changes all sorts of things like underestimating their tax liabilities and late payments and things like that. So yes, you definitely want to you want to do your planning the year before you start the tax year, not at the end of the current tax year that you plan for what you didn't do in January.
Yep.
Mm-hmm. And these vehicles that we're talking about, these charitable vehicles, like I know if you form a defined benefit plan and you only get like that 30-cent tax reduction, but there's money in it for you at the end. Like once you reach a certain 2 million, like 2.8 million threshold or something, you have to take that out. You have to shut that plan down, but it's in your name. So it's your money. Now, if you do something, yes, you're going to have to pay taxes on it in the future. You've only deferred it, but you still own the money. When you do a leveraged charitable structure like that, isn't the money gone, it's not yours, right? You're giving it to charity.
But you save 40% in cash. So if you have $1 million and you've got a $400,000 tax bill, it generally will reduce it by about 40% on how much cash you have to put in. So the play is growth for potential exit. So you take that 40% cash savings, you go put it into sales and marketing, which is going to increase your revenue, and then you're going to be able to get more profit in future years and continue to recycle and repeat until you get to an exit, or allow the company to continue to operate and install like a C-suite.
I see. Wow. Okay. So yeah, there is a lot of strategic planning going on here, Arron. I see how this works. So as we're just talking about all this tax planning, what do you see as the most overlooked opportunities that you help people capture? Perhaps it's this one, this leveraged charitable thing, but just kind of give us some ideas of what other things we small business owners might be missing that we shouldn't be.
I like the Augusta strategy. It's a fun one that most small businesses can use very, very easily. And I know that it's been talked about a lot. So that's a good one. I do like the leveraged charitable structure. It's really, really good. I like oil and gas as well. If the client uses leveraged charitable, because we kind of layer strategies one underneath the other. So if you can save 40% in cash and then go put it into oil and gas, well, now you can bring that AGI even further down, and it's got a good rate of return. I don't speak to that too much. I'm not an investment manager, but it's traditionally got a pretty good rate of return for oil and gas. So you layer all of these different structures underneath it. And a fun one I heard about recently in a training was, no one says that you have to fly somewhere. So a lot of what I've heard is that you can actually take a cruise. If there's a reason to go there, again, you can't do this fly by the seat of your pants. But if you go to, say, Hawaii, and there's a conference and those types of things, and you actually go there and do the conference, log it, make sure you've got photos, it's on the calendar, do it up correctly. Nothing says in the code that you have to fly. So I have heard of people taking a cruise with their spouse who also works in the business and who also is going to that same event and tracking everything. But that is another way that people can take some value away from the business and have some fun at the same time.
I love these ideas. This sounds great.
Anything
going on in Tahiti I could get to?
But it's got to be structured right, and you probably got to plan it out a little bit, and the stars have got to align a little bit, but it could be a really fun play.
I know that must be true. I know that must be true because one of our member societies that I belong to, the professional societies I belong to, is doing a cruise, and it's structured as an instructional cruise. So we're going to be studying the whole time that they're cruising, but it sounded great, but unfortunately didn't fit into my calendar.
Oh, I love it. That's what we can all do when we retire. We can go teach on these educational cruises. I love that idea. Every cruise I've ever been on, it's been stargazing or, scarf flying, art designs, cooking, things like that. We have some time, Arron. Can you give us maybe a couple of your success stories that you could share with us, some of the things that you've done for people that have helped really make a big difference?
So by using these leveraged charitable structures and other structures underneath it, I've been able to take some companies from $20,000 a month to $2.5 million a month in as short as 2.5 years. And then with these types of structures, and as you're kind of scaling through, what you're able to do is you have two choices as you scale aggressively. The first is you can exit, or you should be starting to remove yourself from the day-to-day so that you can go for that exit over time, make sure that you've got all the risk factors dealt with, and then do the multiple at the end. In this case, he went for an exit, and we ended up getting a 25x offer for this company. And it was a service-based business, but these are the types of things that can be done if you've got the right CFO, and it's allowing you to plan out where you're going and making sure that you have the points that you can look to and where the bottlenecks are in the business, because they're going to break at every stage possible, and they're going to break again and again and again. But if you've got that oversight and someone can point to it and say, fix this every single time, or you can do it yourself, or AI can do it, makes it even easier. So
no.
we've got
AI can do anything. No, Arron, it can't replace you. It cannot replace your brain. Don't let it.
I'm building an AI that can replace me. And basically, I'm going to be the person that has the relationship that they can call and talk through strategy and do those. But it can read all the data the same way I can. It's just a matter of training it on the right methodology, and it'll be able to then be like a CFO in people's pocket.
Oh, well, thank you for coming today. We have certainly appreciated having you here. And thank you again to my co-host, Evelyn Klein-Whitfield, a tax resolution specialist. Thank you, Evelyn.
Thank you.
And our guest next week will be Joy Slaybaugh of Financial Conflict Resolution Institute. So thank you all again for listening in, and we hope to see you next month here at Money Matters TV. Thank you.